On everybody, Real Estate Ninja here. I hope you are doing great. Got big news. It's right here. JP Morgan's going through some big changes. Little feller. Biggest bank in the country is having to find some different ways of making money because things are not looking well. As a matter of fact, things aren't looking well for a lot of banks. We're going to cover that right now, but just real quick. This is the Real Estate Ninja channel. This is not the Economic Ninja. This is a second channel. It's actually blowing up right now because the other channel's being held back. So if you don't mind hitting the subscribe button, I'd really be stoked. Hit the bell icon. There's all kinds of financial news. It's totally separate, but the same. Separate, but the same. Look, we're going to talk right now. These are my notes. There's information in here, and I want to get it to you, but I want you to understand this. As everything's coming crashing down, and it is, and it happens little by little by little, and then all of a sudden, I want you being ready for this because this is a group of people, a nation of people, if you will, around the world that are getting prepared. They're not scared, and they are getting excited about this next crash. It's way more than just someone going, I hope that we have a recession so rates go down so I could buy my first house. No, this is a lot bigger than that. A lot bigger opportunity, and I don't believe you're going to see an opportunity like this in your lifetime again. So if you don't get ready for it, well, that's just on you. Grab your coffee, dive in, here we go. First story, if I can open this, out of the Daily Huddle. It is entitled, $40 billion in unrealized losses hits JP Morgan Chase as Bank of America, Wells Fargo, and Citigroup face exposure to US Treasuries. Remember, as rates keep going up, if anyone, including a financial institution or a bank, is holding bonds to maturity, bonds that they bought a year, 2 years ago, shoot, even like a month ago, they're losing value because as new bonds come out with new rates, the government's like, hey, we the government, we need more money, we're broke. Oh yeah, we'll pay you higher rates. Everyone else is like, I just bought one of those things like last month. And like, sorry, we're going to give these new people higher rates. And it makes their value of their bond go down. And it's been getting really bad. As a matter of fact, we are in a 300-year bond bubble bust. As a matter of fact, it's true. We have not seen a time in history since the 1780s that we have seen 3 years of consecutive loss in the bond market. That is correct. So when I say this is like no other time before, I'm not joking. As a matter of fact, we haven't even seen in recent history where the Fed goes, we're going to lower rates. We're going to keep rates even. We're going to go up rates, to where rates did not do what the Federal Reserve said they were going to do. When the Federal Reserve says something and they go, hey, we're going to raise rates, rates go up. And then when they say we're going to keep rates steady, they stay steady. When they say we're going to go down in rates, they're going to go down. This is the first time really for sure since the 70s, that all of a sudden rates just went completely bonkers. The Fed's like, well, wait a minute, wait. We didn't raise rates this quarter. Why are they still going up? Well, Federal Reserve, it's because the market's in turmoil. Yeah, but we didn't raise rates. Why are they going up? They keep going on up. Hey, rates, we're not gonna go up. What? They're not listening to us. That's because Federal Reserve, you have completely lost your way. The truth is that bond rates keep going up because things like the government are so broke, and individuals and institutions understand this. They're so insolvent that people just don't want to give them the going rate. They are asking for higher rates. The bond market is demanding more interest rates. Well, not only that, we also have this pesky little thing called inflation. It's actually created by the Federal Reserve, central banks, and the government. But you see what I'm saying? It's out of control. I hope you're picking up what I'm dropping off. Big opportunity, mondo opportunity. So it says right here, JP Morgan Chase has quietly revealed tens of billions of dollars in losses. So JP Morgan's like, everything's going great. Okay, so right now we're actually losing a lot of money. Just like the ninja said, lots and lots of money. Don't tell anyone. Anyway, everything's looking great. That's what they're doing right now. They're quietly revealed that tens of billions of dollars in losses on securities, according to a new report on the company's overall balance sheet. The banking giant is now stuck with roughly $40 billion in unrealized bond losses as of Q3 this year, which is a 20% rise. All right, now, we're going to have to come up with ourselves a game plan. First off, fix his hair. This is not a bro hawk. This is not indicative of normal bro hawk. See, you get something different on the Real Estate Ninja. Different bro hawk, different attitude. Point being is that these banks are trying to keep it quiet. See, the big banks, JP Morgan, Bank of America, Wells Fargo, they're really excited about all these other banks. See, they're losing $40 billion. This is the biggest bank in the country. That's okay. They could weather that storm. I know it sounds crazy, but they can. They want all the little banks that can't weather the storm. We just had another bank close their doors. What was it, last week? They want to be able to take their deposits. They want to buy up their deposits and their assets and then take the crap and just go, put that in someone's pension fund. It's how it works. And then they want to consolidate. They want to become bigger and bigger, too big to fail. You get what I'm doing? This is big opportunities here. It says the news follows a quarterly report from Bank of America revealing that it now has a total of $131 billion in unrealized losses. They're worse. That's number 2 bank. So number 2 bank has $131 billion in losses, where number 1 bank only has $40 billion in losses. Oh, okay. Although Wells Fargo and Citigroup have also reported third quarterly earnings, they have yet to reveal the latest stats on their own unrealized losses. Why would they be waiting for that? It's because crap's getting bad. 2024 is going to be an amazing year. And when I mean amazing, it's going to be crappy, but it's going to be amazing for you and me because we're crushing it because we're in Ninja Nation. It says the dangers of unrealized losses came into focus this year amid the collapse of Silicon Valley Bank. The bank's sudden failure back in March was sparked by an announcement that it had booked $1.8 billion in losses from selling a portion of its underwater bond portfolio. See, and this is what's very important to understand when it comes to unrealized losses. It's not a loss until you sell it, right? But the value shown on the balance sheet shows that it is a mere fraction of what it once was worth. So the bank has a difficult time recapitalizing itself because, let me give you an example. All right. Under Basel 3, let's talk about Basel 3. A tier 1 asset, as a matter of fact, even Basel 2 Accord, right? They set up banking rules. They say, okay, banks need to have certain types of assets, and they have these broken down, tier 1, tier 2, tier 3 assets. Tier 1 assets have always been government securities, government bonds, right? Treasuries, things like that. And then they just recently changed it to where they added gold. Why gold? See, you notice the gold just keep going up. That pesky gold's like around $2,000, like all-time highs in dollar terms. It's holding its value. It's doing exactly what it is supposed to do. But what's not doing what it's supposed to do is those other tier 1 assets, the treasuries, right? Or the bonds. They're actually going down in value. Well, see, a bank every night when loans are made during the day, it has to add up how many loans it had made, given money out the door, and then how much money did it bring in deposits. And then what happens is there's a ratio that the Federal Reserve keeps them at. Like, you're only allowed to have that 9-to-1 or whatever it is, ratio of money to loans. And so they go, okay, well, we're a little shy on deposits. So in the middle of the night, they got to go and borrow money from other banks, right? Well, in 2019, right before this pesky flu thing started, literally a month and a half or a month afterwards, the banks were collapsing because none of the banks trusted each other because they were all trying to run and get money, and none of them had sufficient assets because they'd loaned out too much in the late teens of the 2000s. So what happens is they turn around now and they go, okay, we need money. Well, they turn around, they go, well, how much is your portfolio worth? Well, in the past, they were still pretty strong because their bond portfolio was worth a lot of money. Now their bond portfolios are collapsing and they need a lot of money. And they can't go to another bank anymore. Why? Because the other bank is screwed. Our entire banking system is collapsing right now. So the proof of this is the Federal Reserve came out and opened up its repurchase window. It says, okay, window's open. It's like, it's closed. Okay, I'm open for business. Who needs money? And all the banks are like, all of us are like, we didn't, what? All of you? Oh, we're screwed. And so what happens is the banks are all now running down there and saying, look, our bond portfolios are collapsing in value. But they're not collapsing in value as long as the Federal Reserve keeps them flush with cash. And you can see the Federal Reserve's balance sheet has been exploding higher. As a matter of fact, they're doing these really quick, and you're only going to hear this here. They do these really fancy things where they set up an agreement. Hey, Bank of England. Bank's like, yeah. I think that's what they sound like. And they go, hey, can we push some of these assets over to you? Because it's a really neat way of hiding. Sure. Can you do it with us? Sure. And they do this swap line thing. And so they have different ways of hiding it. But it's not a loss on the bank's balance sheet until they sell it. Well, Silicon Valley Bank was the first one. They shot themselves in the foot and they sold those bonds. And they took a big loss, 1.8 billion. And that's what started the whole cratering. Okay. And that's why right now, the scariest thing in our market isn't just these bonds, it's commercial mortgage-backed securities. And you see with commercial mortgage-backed securities, these are 10 times worse than what happened with mortgage-backed securities in 2007. And what's going to happen is one of the banks that failed, those commercial mortgage-backed securities still have not been sold. And no bank wants to buy them. Why? Because the second they do, it now gives a value, a face value. Right now it has a face value. It gives a real value. Like, let's say those commercial mortgage-backed securities that are non-performing, they're horrible. They should be like junk-rated bonds. Once they take a massive hit, like they get sold for 10 cents on the dollar, that's pretty much what everybody's underperforming, non-performing commercial mortgage-backed securities are worth now on their balance sheet. And even if it's not realized because they haven't sold it, analysts are going to value it at that. You see what I'm saying? I hope people understand where I'm going with this. I'm trying to break it down to the simplest form possible, but it is pretty crazy what's going on. Now it says, as a whole, Moodys. Now again, remember, Moodys and other rating firms are already downgrading banks right now. The last time that we had the great financial crisis, they were so late to the game, it was crazy. They're now, in most people's eyes, early, because there hasn't been a collapse yet. But I'm telling you, the collapse already started in this spring. Okay, we're already in the midst of the greatest financial collapse next to the Great Depression. This is very, very serious. But because of the timeline in which information's coming out, or like it says here, you don't realize these losses, the banks don't realize them until they sell them. But we all know what their value is. Okay, so the banks are very under capitalized right now. This is worse than the Great Recession for sure, and we're getting close to where we're going to be at Great Depression levels. It says, as a whole, Moody's estimates that the U.S. banking industry is facing approximately $650 billion in unrealized losses, as reported by Reuters. Those losses stem from a historical collapse in bonds amid the Fed's push to keep interest rates higher for longer. And that is very true. They are going to keep rates higher for longer in 2024 until we have a stock market crash. Until you see about 20-25% peeled off of the value of the major indexes of the stock market, you are not going to see the Fed pivot. All right? They will pause, but they will not drop rates until you see massive losses. That's including your job, your home's value, real estate, stock market value. Okay. And then by then, if you're not ready for it, you're not going to be able to take part in it because the banks will not allow you to. All right. Now check out this second story. And I think this is very important. And thank you to everybody that's hitting the subscribe button and the thumbs up button. You really are helping me out. Thank you. JP Morgan is seeking out a partner to accelerate its private credit push. Isn't that interesting? It says, JP Morgan Chase and Company is searching for a potential partner to grow its private credit business and accelerate its push into one of the hottest areas in leveraged finance. According to people with knowledge of the matter. Isn't that nice? They're just trying to leverage even more. The discussion with prospective partners, including sovereign wealth funds, pension funds. Remember what I told you about pension funds? Including pension funds, endowments, and alternative asset managers began in recent months and are at early stages. The people said, asking not to be named, discussing a private situation. The structure and terms of a potential partnership haven't been finalized, and it's possible more than one partner may have been selected. JP Morgan approached some firms and received inbound inquiries from others. One of the people added, JP Morgan is looking for third-party capital to supplement the more than $10 billion of balance sheet cash it already has set aside for its private credit strategy, which it began rolling out in the last year. A bigger pool of capital would allow the bank to better compete with heavyweights such as Blackstone, Apollo Global Management, and Ares Management Corp. By making larger commitments or participating in larger deals. Senior JP Morgan executives earlier this year told clients the $10 billion is just the starting point, a person with knowledge of the matter said. So you've got JP Morgan moving from banking and investment banking into the private sector like BlackRock. This is scary stuff. Wall Street banks are trying to figure out, and they want to use, and again, they're going to use your pension fund money. Please understand how serious this is. You need to become your own bank. You need to become a lender. Wall Street banks are trying to figure out the best way to compete with private credit, which is eating into the market share of the leveraged loan and high yield bond markets. Remember, high yield bond markets, and I wish people understood how this worked better. I don't know how to. We're moving into some scary times. It says here, investment banks typically sell junk-rated debt to large groups of institutional asset managers rather than hold the risk on their balance sheet, whereas private credit lenders are specialized asset managers, specialized asset management firms that originate the loans directly from their own funds. The truth is, with this bond market melt up right now, banks are taking massive losses, and they're trying to grasp at anything they can to make money. And I believe that's going to move them into debt markets that are stupid markets. Like we're talking junk debt markets. And that desperation leads to bigger collapse. And I believe that you're going to see something in the future that most people are going to think I'm completely nuts in. There will be a government in place, I believe, in the future that will not bail out the Federal Reserve. The Federal Reserve has been here 3 times. This is the 3rd and most recent iteration of the Central Bank of America that was born out of the European or Bank of England, that central bank. And I believe there's a day where you're going to see the government actually collapse under the weight of its own debt, and it will have to renegotiate with the banks. But that negotiation is going to be so dire, so scary, that will leave most people holding bags of nothing. But there will still be a group of people around the world that were prepared for this and are taking advantage of this. I believe that you will see a day, I'm not joking, where BlackRock will cease to exist. I know it sounds crazy, huh? They're going to fall because they're only as strong as the money they've got coming in. If they don't have any money, because the people don't have money, they're going to be done. And there is going to be asset fire sales. I want you ready for that. I want you to join this journey. If you're part of Ninja Nation, put it down below. And if you're not, read the comments of the people that are part of Ninja Nation. They're amazing people. And this is the greatest opportunity of your life. Please understand this. I believe this is the greatest opportunity of your life. Start to invest in yourself. Start to invest in your own mind right now. And don't listen to the minutia, all the white noise out there. There is an epic opportunity coming, and it is time to take advantage of it. The Real Estate Ninja is out.